Hello, and welcome to the September Market Update webinar. My name is Dan White, one of ARK's associate portfolio managers, and I will be moderating today's call. This call was pre-recorded on September 11th, 2025. With that, I will now turn it over to ARK's CEO and CIO, Cathie Wood. Cathie?
Okay, thank you, Dan. And thank you everyone for joining us. I'll be very quick today because it does seem like inflation and interest rates are resolving to the downside as we expected, and that tariffs, they're working their way through, and it does appear that businesses are taking the hit, more than half of the hit. Yes, consumers are seeing higher prices for some goods in particular, but businesses are taking about, the last I saw was 54% of the hit. And we do believe that the PPI this week was important, minus 0.1 for both headline and core. And then the CPI, which also came in line with expectations for the most part, with the exception of shelter being higher than expected. And we know that home prices and rents are starting to fall, and that there's going to be a long tail of falling prices because of the big lags in those indices. The other thing I'd like to focus on is valuation. And valuations have gone up in the innovation space generally. But if you take a look at the last time that happened, pre-COVID, we have to take out the boom bust associated with COVID because we don't think that will ever happen again, even if there were a pandemic. We believe that governments have learned the hard way not to throw money at it. It only causes problems for years afterwards. So we think that was a special case. And taking that out, if you look at the last time, relative valuations were at this level, and that would have been 2016-17. What we saw in the years following, 17, 18, 19, is relative valuations actually fell over those years, but the revenue growth and margin expansion associated with many companies in the innovation space overwhelmed that valuation compression. And as we have been illustrating over the last few years, as we think about valuation, we make that assumption that the valuation of our portfolios is going to compress towards a market multiple over the next 5 years. We do not depend on valuation to get our compound annual rate of return expectations. In fact, quite the opposite. We assume we're going to be penalized. And I can tell you, given our valuation models, that the compound annual rate of return we expect is very much in keeping with the minimum 15% hurdle rate of return. In fact, significantly above that. So with that, I will hand it back to Dan with the thought that we do believe we're in a bull market that is broadening out, a very healthy bull market, climbing a wall of worry. There is a lot to worry about. Wars and even turmoil in the U.S. Along political lines recently. And yet we have this wall of worry, the market climbing this wall of worry and broadening out, we think, which is very much important in terms of the market sustaining this bullish momentum. So with that, back to you, Dan.
Thank you, Cathie. And listeners, most listeners know if you want Cathie's longer, in-depth version of that dialogue, please turn over to ARK's YouTube page for Cathie's monthly In the Know series. That breaks all that down with charts. Now we will begin the question and answer portion of today's webinar. Questions were received from our clients, distribution partners, and sent to our fund's X and Instagram accounts at ARK_funds. Cathie, first one's coming back to you, kind of a high level question here. It seems like passive index tracking investing only further inflates valuations of the largest companies. What is ARK's view on this phenomenon?
We have been talking about this phenomenon, particularly in 23 and 24, as the market was hitting all-time highs, and it was powered by the largest stocks in a very concentrated indices by historical standards. So yes, self-fulfilling prophecy. And this is the battle we've been fighting from an active management point of view for, I'm going to say, 20 years. Really, this started after the tech and telecom bust, and even more so, it accelerated and gained momentum, this move towards benchmark sensitivity or passive after '08 and '09. And so we think the pendulum has swung far enough, but we thought that a few years ago as well. As I mentioned in my introduction, the market broadening out here is really important. And we do think that there's going to be a breakaway for innovation stocks, truly technologically enabled disruptive innovation, we think is going to start outperforming these indices. Why? It is because some of the largest holdings in the broad-based benchmarks are going to be disrupted themselves. Many people have been talking about Apple and its inability to get its footing in the AI space or in the autonomous mobility space. What is the ultimate mobile device? It's an autonomous vehicle. And Apple had been trying to break into that world, and I think for the last 6-7 years. And we've seen one turnover after another in terms of strategy and management teams. So that's a candidate and is a very large part of the index. Google, we think, is one of the best AI companies in the world. It has some of the best talent in the world, from DeepMind, an acquisition from the UK. And yet it is in harm's way from this point of view. It has had a lock on the search market. And now there are many more players. Perplexity, of course, is one. Even Bing, with OpenAI and Microsoft, is gaining share. Now, Google is also combating that, but the fact remains it had it had roughly 95% plus of the search market, and that is changing. And even Amazon, again, we love Amazon's positioning in the cloud. We think the cloud is extremely important here. Oracle's report put an exclamation point on that. And yet Oracle could it be a spoiler in this market? We noticed that Amazon's cloud margins went down while its revenue growth did accelerate. That's an open question. And of course, agentic AI calls into question whether or not we're going to, as we are on shopping expeditions, whether we're going to let our personal assistant do the shopping for us, or go back to our old habits and start with Amazon, which historically has been the first place many people did start their shopping expeditions. We don't know. And so the very comfortable world that those companies dominated is changing. And we think that there are many other companies that are much quicker, more agile, But as Nick Gruss, our Director of Research for Consumer Internet and FinTech would say, distribution, distribution, distribution. So we have a live debate here at ARK. Our Brett Winton, our chief futurist, is somewhat skeptical and thinks that there will be more disintermediation than many analysts out there expect. So bottom line, we do think the market's going to broaden out here as some of the most important and biggest positions in these benchmarks start to disappoint, maybe not in a huge way, but at the margin. So with that, back to you, Dan.
Yeah, thank you, Cathie. And just the sheer size of that like passive universe, everyone thinks the broad benchmarks in general. There are a lot of funds out there that are quasi benchmarker or benchmark hugging that really it doesn't come up in that first initial look. So that pendulum has swung quite far. Um, the next question, turning to the crypto side here with Lorenzo. A lot of talk about digital asset treasury companies or DATs. Can you please explain ARK's just general thesis here?
Yeah, of course. So maybe I'll give a brief overview. DATs are companies that trade publicly that are accumulating as much Ethereum, Solana, or Bitcoin as possible. And so it really depends on the mandate that they have. We've invested in Bitmine, and so as an update on Bitmine, they now hold more than 2 million ETH on their balance sheet, and I think now they have more Ethereum than the rest of the top 10 Ethereum DATs. So they've really pulled away and hit escape velocity. They've been able to increase, to continue to increase the ETH per share. And so I think in terms of the thesis down, we think DATs are interesting wrappers. They are, for certain assets and specifically smart contract layer ones and even some of the other altcoins are a more efficient exposure given the yield bearing nature of these assets and the flexibility that you have with these assets to use them on chain to generate potentially more revenue. So that is the general thesis. If we compare them to ETF, and we've talked about this, for now, staking is not allowed, and even if it were, we believe they're going to be able to stake a portion of the AUM, and so it will be from a revenue perspective and yield an inferior product. So that really is the thesis. I think overall what we've seen, in the first 2 months, mNAVs have really compressed, right? Like in the past weeks, a lot of these DATs are trading now between 1x mNAV and 1.1, 1.2. And so I think the first phase was really to leverage the ATMs and be able to increase the ETH or Solana or Bitcoin per share. I think perhaps now we're really looking at the market with some compression on the mNAV, and so perhaps we're hitting a second phase where they'll need perhaps to repurchase the shares, which we've seen with SBED and a couple of other DATs, or perhaps tap into the debt market or convertible. And so we're actively monitoring the situation and the space. I think one interesting point also for Bitmine, they've just invested $20 million into 8Co, which is the digital asset treasury that is accumulating WorldCoin tokens. And so they own about 13.7 million shares of the DAT. And I think Tom has said that they want to allocate about 1% of their balance sheet to Ethereum ecosystem opportunities. So that would be either DATs or perhaps underlying tokens. And so that really has been the first investment, from Bitmine. And so I think we're very much entering into a more mature phase, and we'll see, how these companies evolved and how they're able to leverage, capital markets in different ways.
Yes, and Lorenzo, just in terms of why we bought Bitmine Immersion in the first place, it was very difficult to gain a toehold in Ether through staked ETFs. We had to resort to the Canadian ETFs because the US, at least so far, does not allow staking in ETFs. And so this was a solution, this DAT, Bitmine Immersion, for Ether was a solution to that problem. We think that the Ethereum protocol is where most of the DeFi or decentralized financial revolution is taking place. And Lorenzo, I know that Bitmine's original goal was to increase its position to 5% of total ETH outstanding. So where are we now relative to that goal?
Yeah, so I think they're a third. They have over 2 million ETH right now. And so again, they've been able to increase the ETH per share really really rapidly. And so if you look at the total supply, Cathie, of Ethereum, it's 120 million. So 5% would be 6 million ETH. And so Bitmine has a bit more than 2 million. So it's about one third there, which they've been able to do that very very rapidly.
Thanks, Lorenzo. And staying on ETH here, the next question is what's ARK's Ether price target?
Yeah, maybe I can talk a bit more generally about the ETH thesis than the price target. Um, we've seen a lot of institutions now, Robinhood and many others build on Ethereum. And so if you look at, we think the biggest trends and in the next 5 years, tokenization, RWAs, stablecoin, and DeFi in general, Ethereum is still very much the leader. You have about 120 billion of total value locked, which is really a value that are locked on smart contracts on Ethereum and layer twos. More than 100 billion in stable coins on Ethereum out of a total of 280, more or less. And so we really think, DeFi and a lot of these trends are being built on Ethereum and its layer twos. It definitely has, liquidity moats. A lot of the DeFi apps, Aave and others, have are really, at least an order of magnitude bigger than on other L1s. And we do think they're, very interesting opportunities. We think Solana is going to be very interesting as well. But if you look at Ether, the asset, we think it's a very unique asset. It's yield bearing, so it's a revenue generating asset. We'll publish more research on that, right? Because as an ETH holder, if you stake, you get yield that comes from the fees that users on paying on chain, so it's revenue generating. Ethereum is used also as collateral in DeFi. If you look at the number one collateral in DeFi and layer twos, it's Ethereum. So putting Ethereum as collateral, taking stable coins as debt, and then it's also a medium of exchange, right? I think less popular now, probably, but if you look at NFT marketplaces and paying fees really on Ethereum, paying for transactions, you need Ethereum, right? You need to pay for those fees with the Ether token. And so looking for in the next 5 years, we think the roadmap of scaling the layer one and the layer twos, which I think a lot of the teams are focused on that. If you look at Base and other chains, I think will allow for more users to come on chain. And so yeah, again, I think we were eager to publish more research and be more specific on the Ethereum price target. But to give you an idea, right now, Ethereum is about 13% of the total market cap of crypto, counting everything. And we have a market value in 2030 of 25 trillion. And so that gives you a bit of an idea, I think, of the expected final Ethereum market cap in 2030. But again, stay tuned for more research on that.
Great. Thank you both. Looking forward to that publication. I think many of us are. Changing gears here a bit to the public equity side. So Sam, how do you react when you hear critics say Tesla has an excessive dependency on its CEO, Elon Musk?
I mean, I would say if you're going to have an excessive dependence on anyone, Elon's the guy you want to be dependent on with all of his execution. And typically what we've said in the past, and I think this is evolving, is that really getting robotaxi across the finish line is critical for Elon's involvement. And then, a lot of things can happen. He could probably step back from the role he's currently in and focus on other things. But I think what we're seeing, and it's good that this new incentive package is in place to align him for the long term. But Elon has a history of taking all of his chips, putting them back on the table to achieve an even greater goal. And I think what we're seeing and hearing here is, robotaxi is a huge opportunity, right? $10 trillion opportunity on that order. But then after that, there's a even bigger opportunity with humanoid robots. And I think it's becoming very clear that, you know, Elon doesn't want to just run an insanely profitable robotaxi business. He wants to fundamentally change how the economy works with abundant labor. And so I think this incentive package is super important. I think we're going to see Elon achieve robotaxi and scale that out, and then put the chips back on the table to try and tackle the humanoid robot problem.
Thank you, Sam. Certainly critical for a lot of ARK's thesis of that productivity boost to real GDP and growing out of the US's deficit. I know Cathie's talked about that a few times. The next question, we have Nick. He's been at the Robinhood Summit this week. And so, Nick, Robinhood has had stellar performance this year. What is your vision for the company long term, and maybe what are the interesting facts you've heard this week?
Yeah, thank you, Dan. This is a great question. And, we're really excited about the strides that Robinhood is making as a company. And I think if you look at the performance of this year in the name, I think it really does boil down to product velocity. And that's something even the company itself would say. We were actually just at, as you mentioned, the Robinhood Summit event, which is their third event of the year, product event of the year. And they're actually having a fourth around AI in December. And I think when you look at it from a product velocity perspective, you can really understand that Robinhood is separating itself from the traditional financial services space. It's very rare to see a company launch this many products in 1 year, let alone continue to commit to launching more products in this space at this pace. And if you look at what they're releasing, Robinhood started as a commission-free brokerage exchange, but I think the long-term vision here is really building out a financial operating system. And so if you go back to the Gold event earlier in the year, Vlad, the CEO, talked about the idea that there is a great wealth transfer happening currently and will continue to happen over the next decade to 2 decades. And we're talking about $125 trillion worth of wealth transferring from the baby boomer generation down to millennials and Gen Z. And Robinhood wants to be the operating system, the financial operating system that is able to take on all of that wealth for these individuals. And I think they're sitting in pole position. If you look at Robinhood as a brokerage account, it really is the premier brokerage account in the US for the millennial and Gen Z generation. And now, if you look, going back to my prior comments around product velocity, what they're launching is very specific to building out more financial services. So they talked at their Gold event earlier this year about banking products. They released an AI, call it concierge and research management tool in Robinhood Cortex. Now they're building out more active trader products, which is what we were just at the Robinhood Summit event. And then also they're building out a social feature. So being able to build a community around the trading, the active traders, and just the trading environment that they have on Robinhood, and being able to keep that engagement on platform. So you look at this company and they're really going after so many different areas. But I think the vision is very cohesive, right? You can sometimes maybe get worried that a company's going after too much at one time. But I think if you look at the execution of this management team and you understand the long-term vision, which is building this financial operating system, being the banking app, being the brokerage app for this next generation, this current generation, and millennial and Gen Zs. This is a really important story, and one that we're actually currently working on putting together research. So look out for a blog around this very specific topic. It's really our new thesis around the digital wallet space, because of what we're seeing with Robinhood and this company really beginning to adopt this idea of an everything app. I called it a financial operating system, but being able to attack this space at a velocity that really is unparalleled in the financial services space. One thing we actually kept hearing at the conference over and over again from management was, we don't view ourselves as a fintech. We believe we're at our core a technology company operating in the financial services space. And I think that really speaks volumes about this company and the long-term trajectory of what they're going after. So I'll pass it back to you, Dan.
Thank you, Nick. Next question, we have Frank. So Frank, what is your view on Palantir's current valuation?
Yeah, sure. Our thesis on Palantir really centers around their positioning as the platform for enabling AI use cases at scale. And I think you see that in their numbers kind of across the board. Their top line revenue accelerated to 40% overall growth this quarter. Their US business is on fire. On the commercial segment, so enterprise software, they're growing 93% year on year, and that was an acceleration from 71% year on year growth last year. And if you translate that relative to their valuation in the market, they're for sure priced at a premium. If you look on a price to next 12-month sales, they're trading around 75 times. The next closest cloud software company is Cloudflare, trading at 30 times. But I think if you just look at that kind of price to sales number, which is used commonly for software companies because not all of them are profitable, it really understates the profitability of Palantir's business, where they had a 57% free cash flow margin in the most recent quarter. And if you look over the last 12 months, they're at a 10%, a 50% free cash flow margin versus Cloudflare's 10%. So 5 times more free cash flow for every dollar of revenue that Palantir brings in. And I think you have to also think of that as in the context of Palantir's businesses accelerating because of their position in this growing AI opportunity. Well, a lot of enterprise software companies in their peer group are still decelerating. I think we did see certain green shoots of the market broadening out, which is really good this quarter. Snowflake and MongoDB is an example of that. But the impact it's had on Palantir's business, I don't think can be understated. And so we really think they're in rare territory in terms of strategic positioning, the fundamentals of the business, and the valuation. And I think we take all of those into account when we're positioning this name in our portfolios. So if you followed our positions and strategies like ARKK or ARKW, as Palantir has really grown faster than the rest of its software peers and appreciated in the market, we've taken considerable amounts of profits, but still balancing that with our conviction in the name, kept it generally around the top 10 because of the magnitude of the opportunity. And also I'll say, you can look at our big ideas reports to see the size of the AI opportunity that we think is to come. And we think the platform layer where Palantir sits is the most important layer, and Palantir is best positioned there.
Right, and we should add, from a portfolio management point of view, I think if Palantir's valuation was not at this level, it would be right at the top of our portfolio with Tesla. That is how high our confidence is in that premier platform as a service opportunity.
Certainly. Thank you, Cathie and Frank. And Frank, staying in your coverage universe here, could you please provide an update on your CoreWeave investment thesis?
Sure. Yeah, CoreWeave is the leading AI neocloud, which a neocloud is essentially a new cloud competing against the, let's say, big four now with Amazon, Microsoft, Google, and Oracle. And they're typically, and CoreWeave especially, built AI native from the ground up. So building their facilities focused on accelerated computing. And CoreWeave's clients include Microsoft, OpenAI, and Meta as examples of some of their largest. And the demand for compute, I think you can see in the market, whether it's NVIDIA's sales or Oracle's earnings that just came out, it is only growing, and that's driven by companies like OpenAI and Palantir that are really bringing AI to market at an increasingly large scale. Their revenue grew 200% plus in the most recent quarter. If you listen to NVIDIA's call, Jensen Huang is talking about performance per watt or tokens per watt, because companies like OpenAI for their API products charge on a per token basis. The more tokens per watt and the more total watts you have, the more revenue the business can generate. And so if you look at that, what that means for CoreWeave, they have 470 megawatts of power deployed right now, and they have contracted power of 2.2 gigawatts and are continuously looking to expand that. So if you just look at 470 megawatts to 2.2, you can see that, on the same price per token per watt basis, they could 4x the revenue base based on what they already have contracted. And NVIDIA, CoreWeave has a strong relationship with NVIDIA, who's incentivized not only because they're an equity investor in CoreWeave and supported them in their IPO, but because CoreWeave is more or less all in on NVIDIA's infrastructure stack. So NVIDIA's largest customers are these big clouds, and they're seeing them all work on their own custom silicon efforts, whether it's Google with the TPU or Amazon with Trainium. And having an alternative option like a CoreWeave that can be a new source of demand and leveraging bargaining power against the clouds is very strategic for NVIDIA to invest in and give CoreWeave good allocations. Outside of kind of this core infrastructure as a service and building really the infrastructure to support the largest companies, they're also looking forward strategically into the platform layer that we just talked about with Palantir. And they acquired a company called Weights and Biases, which is tools and services for AI developers to build and train models that gives them a great top of funnel lead gen and really broadens out the customer base beyond just these largest top 5 to 10 clients in the AI space.
Great, thank you, Frank. This next and final question is a follow-on question actually from a few months back. So to the Genome team, previously we had talked about deregulation in the healthcare space. Could you please provide an update on that?
Sure, thank you for the question. So let me focus then on some of the biggest changes which are coming out of the US Food and Drug Administration, or the FDA. So at a high level here, we've seen a clear shift in stance with the FDA Commissioner, Dr. Marty Makary, and the Health and Human Services Secretary, Robert F.K. Kennedy Jr. They've been really vocal in acknowledging and committing to addressing the roadblocks in the regulatory process. So this includes rigid and costly regulatory barriers that slow innovation and push development overseas. So we're still facing increasing clinical development costs and a 90% clinical trial failure rate. So there's really an important need to tackle this. So the FDA is proposing several forward-looking reforms, and this includes building deeper partnerships with industry with a goal to reduce regulatory uncertainty, also enhancing regulatory efficiency and productivity by leveraging tools like AI, piloting alternative trial and study designs that are better suited to the diseases being studied, and introducing new approval pathways, especially for rare disease therapies, or even an N-of-1 approval pathway for bespoke personalized therapies, certainly following the success that we saw with baby KJ, who had a metabolic disorder and a custom gene editing therapy was developed for him in a little under 6 months. Another relevant example here is fast reviews for national priorities. So there's a new national priority voucher program that they'll be launching, and this will allow review times to finish in 1 to 2 months instead of 10 to 12 months. And these will be for medicines that are addressing diseases and conditions of high burden here in the US. Another dynamic I would highlight here is the push toward more predictive drug development. And so the FDA is actively encouraging next-gen approaches to reduce reliance on lengthy, expensive animal testing by encouraging more predictive preclinical methods. This includes AI, multiomics, microphysiological systems like organs on chips, and other next-gen technologies that could accelerate time to market, significantly lower development costs, and improve R&D returns. And this could especially benefit companies that are already leveraging these tools. And I would sum here really that the FDA is actively pivoting toward a more innovation-friendly paradigm, embracing faster approvals, flexible trial formats, and really encouraging more predictive preclinical models. And this direction really aligns closely with ARK's long-term themes in multiomics.
Yeah, and I'll just add one last exclamation point. Thank you, Shay. This is a recording, but as of the day of the recording, Tempus received US FDA special 510K clearance for its updated Tempus Pixel device. And this is an AI-powered cardiac imaging platform. So Tempus is really distinguishing itself, we believe, in this convergence between AI sequencing technologies and diagnostic. We know that the large pharma and biotech companies are facing, I think it's a $300 billion hole in their revenues during the next 5 years as their patents expire. So they are going to, and we're beginning to see them embrace some of these new technologies because they know they have a problem. And they may also be targeting some of our companies to help them fill in their holes, their revenue holes. Now, we don't want our companies to be taken out, but what we do want is strategic price discovery out there. And the M&A environment has picked back up, and we are beginning to see a lot of M&A in this space that is justifying our positioning in this space.
Certainly. Thank you both. And that will conclude today's webinar. We will briefly show performance statistics that can be found on ark-funds.com. Thank you to everyone who listened today to today's call. And of course, thank you again to the entire ARK team.